Rakshit Ranjan, a portfolio manager at Marcellus Investment Managers, is joining us on the show right now. Thanks very much for taking up the time, Rakshit. Let's start off first with the overall view at Marcellus as to how you're going to be approaching investing in a market like this.
Sure. So our view was, is and remains that if you want to approach investing in Indian stock markets at any point of time, it has to be by means of stock picking, because the underlying indices, they over a longer period of time, in any case, they deliver no more than 10, 11, 12% earnings growth, and hence you shouldn't expect more than 10 to 12% of return from the broader market, which is not a satisfactory return for most investors in equities. And hence, once we approach our clients' portfolio construction, we approach it purely on the back of stock picking, where we are highly confident of sustenance of healthy earnings growth run rate into the future. That view, in fact, becomes all the more important in the current climate, because if you look at the last, say, 4 or 5 years, so over the last 4 years, Sensex and Nifty have grown earnings at pretty much 0, 1 or 2% CAGR, which means that over the last 4 years, earnings of Sensex and Nifty has not moved anywhere. However, the index values have gone up at a rate of 8 to 9% annualized, and hence, if you look at the aggregate over a 4-year period, the index is at least 25 to 30% higher than where the fundamental support is compared to 4 years ago. Now, that in itself is a warning sign, and hence we've been advising clients that do not approach this market as a broad market buying opportunity. However, if you go for stock picking, then our portfolio companies, we have 12 companies in our portfolios of clients. In our portfolio, there are the companies have delivered about 18-19% earnings compounding over the last 4 years, and their share price movement has also been in sync with earnings, which is somewhere around 20 to 22% share price compounding. So as long as you are sticking to healthy earnings compounding, where fundamentals are fully supporting the valuations, then there is no reason to stay out from investing. There is every reason to go in, and that's what we are doing for our clients, but that might not be the case for the broader market.
Rakshit, afternoon, we had the Citi team today talking about how Q1 might shape up. The expectation is that, at least their expectation is that the net growth could be 3.5%, 4% at best and nothing more. In this dampened earnings environment, which is that pocket where you reckon the earnings growth has a higher probability of not just delivering in Q1, but through the rest of the year as well? Because, like it or not, these are a bit uncertain times because of the economic slowdown.
Yeah, certainly. I mean, so in terms of pockets, so certainly we haven't seen a big capex growth. At the same time, you have seen some of the consumer companies also report a bit of moderation in their growth run rates over the last couple of quarters. So there is moderation in growth across various parts of the economy. However, I was just listening to what you were streaming live a couple of minutes ago. Bajaj Finance, a great example. HDFC Bank, a great example. These are also firms which have come out with their quarterly trading updates. By the way, I have to disclose that both these firms are there in our clients' portfolios, and we at Marcellus are also clients of the same PMS, so we hold it in our personal capacity as well. Now, coming back to HDFC Bank and Bajaj Finance, so what you're noticing from their reported numbers for the quarter is that where you do have a very weak macro environment, and hence you do have too many companies likely to report very weak numbers. As you quantified, 3.5% is someone telling you is the expectation. In the midst of this, if you can have HDFC Bank grow at 17-18% in its loan book, if you can have Bajaj Finance grow at 40-41% in its loan book and sustain the quality of the asset portfolio as well, and likewise in every sector. So if you can pick up, let's say, a paint company or a footwear company or some other such company which is in a sector which might not be undergoing significant buoyancy, significant euphoria in the broader external environment, but by means of market share gains, by means of expanding the size of the canvas in which they operate, if they can report a decent number in a weak environment, that's really the kind of stock that you should have in a portfolio. And hence that's probably the only way to make money. Otherwise, I agree with you. Maybe the 3% that you are getting might be a bull case scenario or a base case scenario for earnings growth in the first quarter.
We were talking to Saurabh the other day, and he pointed out towards one stock which was Relaxo that he liked. Within from a consumption-oriented standpoint. Is there anything, within the consumption space that attracts you other than Relaxo?
So, as I said, we have 12 stocks in our clients' portfolios in the PMS. All 12 are in some way or the other linked to the middle class household consumption as the underlying theme for these companies is revenue growth. So whether it be, let's say, the HDFC Bank, Bajaj Finances of the world who are lending to retail borrowers and hence are linked to middle class consumption again, or whether it be Relaxo, which you pointed out just now. The remaining 9 stocks as well, apart from these 3 in the portfolio, we have a couple of paint companies, we have the country's largest adhesive company, so on and so forth. So pretty much the entire portfolio that we have is interestingly linked to the middle class household consumption. Now that's not because we wanted the portfolio to be like that. It's actually an outcome of our approach towards stock picking. So our approach tends to be that look back at the last, say, 10 or 20 years of history, seek consistency of fundamentals, consistency of healthy fundamentals, and then understand if the reasons why historical fundamentals were healthy and consistent, if those reasons can sustain into the future as well, then buy into these companies and hold on to them for long periods of time. So that's the approach. Now, within this approach, fortunately or unfortunately, you don't have companies outside of middle class consumption oriented categories that have delivered consistency in the long term history, and hence we believe that have the ability to deliver long term consistency into the future as well. So because of the way we approach portfolio construction, we've actually got only consumption oriented plays, whether that be consumption by means of financial services, whether that be consumption by means of discretionary or staples, so on and so forth. So it is actually a consumption oriented portfolio that we have.
Okay. Rakshit, any bets towards the capital investment theme at all? The reason I ask this is because somehow some of the power companies, and not technically into the capital investment theme but economy related, but power companies have made a bit of a comeback. Cement pricing, if not volumes, have looked very strong for the quarter gone by. Anything within this capex related theme that excites you?
So since we approach a company from a very long holding period perspective, we don't have any of the capex heavy plays in our coverage universe. However, our philosophy is not the only or the best way to make money in the stock market. So what you are saying might be one way to make money. However, the skill that you require when you do capex oriented plays is a little bit of timing of entry and exit matters when it comes to investing in such stocks. And since we have a totally different way of approaching stocks, we don't have these companies in our coverage universe.
Fair point, Rakshit. But yeah, maybe the way you approach investing and stock picking doesn't allow you to do so as well, which is fine, as long as the portfolio creates wealth. Thanks so much, Rakshit, for joining in today and giving us your thoughts. Really appreciate your time today.